Hello and welcome. I'm Tom Ross, Head of High Yield and Portfolio Manager on Multi-Sector Credit team. And today I'm joined by John Lloyd, our Global Head of Multi-Sector Credit. We've recently been meeting with lots of clients, and so we're going to share with you some of the key questions that those clients have been asking. And then we're also going to touch on topics such as AI, rates, and also where are the opportunities and how to invest, we believe, in the future of fixed income. Okay, so John, first question for you in meeting clients. One of the key questions is spreads are really tight. What should we do?
Yeah, I think an overarching theme is you want to maximize spread per unit of volatility in these type of environments and not stretch for yield. There's lots of relative value opportunities across the sectors. There's also a lot of dispersion within the sectors and themes you can invest in. We'll get to AI, but AI is a huge theme we've been investing in. And I think there's a lot of reasons why spreads are tight.
Yeah, so I mean, if we think now, like tight spreads don't necessarily mean they're going to widen, but we've got better credit quality within most of the public credit universe. We've got lower duration within areas like high yield as well, and generally the fundamentals on corporates are looking pretty good. So I think spreads are tight for a reason, as opposed to saying spreads are tight, therefore that means they're going wider.
Yeah, and we've had lots of time periods, early 2000s, 2010, where we had long stretches of tight spreads that you still want to harvest yield in. You just want to do it in a responsible way. So I think those are examples where you can still get comfort in kind of a tight spread environment. And the fundamentals are really strong. GDP growth in the US is above trend. Europe's been accelerating. I know we've had some conflicts this year that have put a hiccup in some of the markets, but that creates opportunities too.
Yeah. Okay, let's move on to AI. So opportunities and risks. Go first.
Yeah, I think we looked at it as a risk in the investment market. The hyperscalers are spending, $800 billion this year, $1 trillion plus next year. That supply is going to come in mostly through the investment grade market. Investment grade spreads are already starting near all-time tights. And I think that supply technical could widen out spreads in that market. So that's an example of a risk in the fixed income market. In high yield and securitized, you can get some pretty good spreads investing in AI. We've seen in the high yield, we've seen examples of investing in kind of second derivatives of AI as well. Utility companies, because there's a power backlog, tech hardware, memory players, and we've seen companies in those spaces get upgraded and spreads tighten.
Yeah. And we've also had the data center deals as well, which were a really great opportunity when they first came. Now it's a little bit more selective, and we've got lots more issuance to come there. But I think that will also drive some opportunities. In fact, in Europe recently, we've had one of the first deals announced for a European data center deal as well. Okay, so let's talk about rates a little bit. How are we thinking about rates, AI, inflationary, disinflationary?
I'm in the camp that AI is going to be near term over the next 18, 24, maybe even 36 months inflationary. We've seen the employment numbers in the US really hold up. One of the stats I like to bring to the forefront is software engineering hiring is up year over year. So if you're going to see job displacement, you probably see it in that sector first, and we're just really not seeing that. And then you get news like Apple raising prices on iPhones. You're seeing it in the hardware, you're seeing it in the utility prices. So, and we're already starting at a relatively high rate in the core PCE. So I think inflation is going to be sticky, and I think it's one of the risks to manage in the fixed income markets. I think also correlations, you want to touch upon the correlations?
Yeah, so obviously that has sort of switched from being negative to potentially going positive again in terms of equity and rates correlation, which is actually what we saw prior to year 2000. So I think that just means we just need to just consider those correlations. Ultimately, as part of many of the strategies we use duration as a volatility dampener. So it's really considering those correlations. But yeah, ultimately, we believe now the best use of fixed income is more that short end carry as opposed to that long end sort of protection type of hedge. Okay, and then to finish off, in terms of where do we think the best opportunities are and how do we invest, or how do we think clients should think about investing in fixed income going forward?
Yeah, another great topic. I think there's an example going back to what I started with of maximizing that spread per unit of volatility. I think in the mortgage market and resi credit space, that's a great way to do it. Why is there going to be less volatility? Well, you have Fannie and Freddie purchasing over, $200 billion in that market. That's probably going to reduce the vol throughout the year in those sectors. So those are areas we like. And generally, we like securitized. It tends to be shorter duration, front end. And those spreads versus their own history tend to be cheaper than the corporate credit side. So it's not that we don't like corporate credit, just securitized offers a little bit better risk-adjusted yields and returns.
Yeah, and I'll add to that as well. In a benign environment where spreads stay tight, then it's that really function to focus on security selection within all of the different asset classes within fixed income. But then if we do get any volatility, that's when being overweight, more defensive but higher yielding securitized right now might then lead to opportunities like we've seen in the past to then switch into those higher convex, more upside fixed income asset classes like investment grade, emerging markets, and high yield. Great. Well, thanks very much for listening. And of course, if you have any further questions, please reach out to your sales representative.